Hello everyone, welcome back to another video. So in this video, we're just going to be talking about, we're going to be wrapping up the first section by talking about what exactly is a stock exchange and explaining IPOs or initial public offerings. So let's get started. So I've already been talking about stocks. You can buy them, you can sell them, you can profit off of them, you can profit off dividend stocks or stocks that have dividends associated with them. But where do you buy them and where do you sell them? So this is where the idea of a stock exchange comes into mind. A stock exchange or a stock market, the definition is already written down in its name. It's simply a place where you can buy and sell stocks. It's like a marketplace. So it's a place where buyers and sellers can gather together. And the key thing or the key product that they're selling to each other is the stock itself. So it's a platform to buy or sell stocks. And in addition, stock exchanges or stock markets tend to be regulated partially by the government to regulate the safe and efficient transfer of stocks. Stocks often need to be registered and listed on a stock exchange or a stock market to be properly traded. That means that the individuals who run the stock exchange must vet the company and make sure that it's not some kind of scam, that it's actually viable for investors to invest in and trade its stocks. So once again, a stock exchange is just a place where buyers and sellers can come together to trade the stocks or buy and sell the stocks with each other. It's just a marketplace, just like a medium. So buying stocks today. So back in the past, it was much more difficult to buy stocks. But today it's gone really easy. And you do this with the help of a brokerage company. A brokerage company brokers or facilitates a stock transaction between potential buyers and sellers. So a brokerage is not the same as a stock exchange. A brokerage is a company that uses the stock exchange for its customers to successfully place transactions. So the easiest way to think about this is that a brokerage company will analyze the buyers and the sellers in the stock exchange. So let's say you go to the brokerage company and you say, hey, I want to buy 100 shares of Amazon. So the brokerage would be like, cool, 100 shares of Amazon, that's what you want. So the brokerage will then go to the stock market or the stock exchange, which is just a place where buyers and sellers are gathered together, and it'll try to look for a seller. Let's say there's a seller who's trying to sell 100 shares of Amazon as well. Well, that's how the transaction takes place. The brokerage knows uh, that you yourself are a buyer who wants to get 100 shares of Amazon, and the brokerage has identified a seller through the stock market or the stock exchange who wants to consequently sell 100 shares of Amazon. Well, that's where the transaction happens. The seller sells it to the brokerage, who then gives it to the buyer, and then the cash is obviously accordingly. So if you want to buy the 100 shares, then your money ultimately goes into the seller's pocket, and in exchange, the seller's stocks or the shares that the seller is selling go back to you. So a brokerage just facilitates that transaction, and a lot of it's done electronically today. There are many brokerage companies, with several big ones being Fidelity Investments, TD Ameritrade, and Charles Schwab. So now I'd like to get into an IPO. So IPOs are really well known, and it's one of the biggest things in the stock market. So let's get started. So before we get into what exactly is an IPO, I want to talk about the two different types of companies, a public company versus a private company. So a public company is accessible to the general public for investment. A public company has stocks that anyone on the stock market can buy or sell. A private company does not have shares on the market. It's uh, no one can buy its stock. It doesn't have any stock. It's just not there. No one can buy into or invest in the company unless there's some kind of special agreement with the existing owners of the company. So a big corporation like Apple, for example, is a publicly traded company. It has stocks on a stock market that you can buy or sell, as a result becoming a shareholder of the company. But let's say that you take some kind of restaurant, a simple mom and pop restaurant in your local neighborhood. Well, that's an example of a private business because it doesn't have shares on the market. And let's say you wanted to invest within that business, or you wanted to invest into that company, then you would physically have to make up some kind of agreement with the owners of that mom and pop restaurant in order to actually facilitate that, in order for you to become maybe a third owner or something of the sort. Uh, private companies can be much bigger than a mom and pop restaurant. There are a lot of companies that before going public all started as private. So at one point, big companies like Amazon, Google, Facebook were all private. Currently, at the time of recording in 2020, one of the biggest companies, Airbnb, which is a hotel and lodging chain that is really unique to most of its competitors. It's a private company. You can't invest in its stocks unless you have some kind of private agreement with the company owners, because quite simply there are no stocks. So that's the difference between the private and public company. With a public company, there's stocks that are accessible to the public. With the private company, there are no stocks. You can't invest in its stocks because they're not there. If you want to invest in it, you're gonna have to talk to the owners and drop some kind of special agreement. So what an IPO refers to is the transition of a company from a private status to a public status. So essentially, the company, quote unquote, goes public by allowing investors or outside investors to invest in the company in the form of stock purchases. And this is called the initial public offering. For the first time, or the initial time, you are offering stocks or parts of the company to the public for investment. That's all that an IPO is. So, for example, IPOs, an example of a really big IPO is Alibaba. It's the biggest IPO in history when it comes to dollar amounts. So, yeah, it's the biggest IPO in history. So, why would you want to IPO? Uh, well, the main reason for deciding to go public is to raise capital. And the intuition behind this isn't too difficult. At the end of the day, the company is opening itself to outside investment by selling parts of the company, by selling tiny shares of the company known as stocks. So when the company is selling parts of itself to an outside entity, the outside entity has to pay for those stocks that it buys. For example, let's say we have a company that's going from private to public by selling stocks or selling parts of itself. If it sells it to like a bank, for example, the bank has to pay the company for the stocks that the bank purchases, and that payment goes directly to the company. So as a result, money flows back into the company, and this allows for a lot of capital to be raised because oftentimes, when you IPO or when you initially offer the stock to the public, you do that at an inflated price or a price that's indicative of future earnings as opposed to the current valuation of the company. So basically, when you IPO, people are going to be buying parts of your company off of you in exchange for cash. So if you need some cash quickly, then a good way to do that is to IPO. It's also really easy to facilitate mergers and acquisitions. So let's say you're an existing public company and you want to buy another public company. Well, when it comes to the accounting and the mergers and acquisitions or the M&A of that entire process, the company's stocks can be used to help push mergers and acquisitions. So let's say you want to buy the company as opposed to doing some kind of complicated financial agreement. Let's say we have two companies, Company A and Company B. Company A is public and so is Company B, and Company A wants to buy Company B. Well, Company A can simply buy some of Company B's shares or enough to get a controlling interest or a majority such that Company A is on Company B's board of directors. And as a result, Company A is essentially a substantial owner of Company B. So company stock is often used to push mergers and acquisitions. And finally, it bolsters company image due to increased transparency. Like I said before, in order for your company to have stock and be public to outside investment, it needs to be vetted and approved. The government and the stock exchange needs to make sure that your company isn't some kind of fraudulent scam that's just going to run away with the investor money. So as a result, if you're allowing this process of vetting and checking uh, to actually be undertaken, then it bolsters the company image because you're seen as more credible. So these are just a few main reasons as to why you should IPO. But the key thing to take away is that IPOs are mainly done to raise capital.